The corporate tax cuts announced by the Government of India at the margin helps to improve the business confidence. There are multiple levels in which this should positively impact. First is it brings down the aggregate corporate tax rate in line with many other emerging markets and makes Indian corporates competitive on a relative basis. First order impact is clearly the companies which pay high marginal tax rate. So there is a markdown of the marginal tax rate by close to 10%, and that is going to be reasonably good beneficial impact on the earnings of the companies. There are counterpoints to that. Some of the exemptions these companies are using would go away, but at the margin I would say net it is going to be beneficial. The second order impact, which is probably more important, is for companies which are going to set up manufacturing facilities from now till 2023, and I think for them the corporate tax rates are much lower at 15%, and this should help to spur investments in the manufacturing sector incrementally. So there is going to be some bit of impetus that is going to come in manufacturing sector. You might see more FDI coming in that space. Some of the manufacturing which is shifting from China, we would see India being incrementally a little more attractive for a destination for relocating those facilities. So net, apart from the listed space, it would also be beneficial for attracting more FDI into India. There are multiple reasons for the current sluggish economic growth. First reason is global uncertainty. We have seen general markdown of global growth rate over the last 3-4 quarters on the back of the trade war between US and China, on the back of Brexit, and we have seen interest rates drop to dramatically low levels. In many countries they are in negative zone. So there is a bit of economic uncertainty in the global scenario, which is kind of playing its way into various emerging markets, including India. That is one kind of an impact on the Indian economy. The second impact, which is more local, is we have seen post demonetization and GST, the economy kind of really struggling to accelerate significantly. Though by itself demonetization and GST may not be the big reasons, given the macroeconomic backdrop, we have seen some rub-off effect of that playing into the corporate growth rate. However, we see the policymakers responding to this slowdown, both on the consumption side, on the investment side, by kind of doing tax cuts as well as dropping interest rates, moving into more accommodative liquidity regime, trying to drive credit growth, trying to ensure the fall in interest rates is passed on to the end borrowers. So we would see that the policymakers are responding to this slowdown, and in the coming quarters we would probably slowly recover from the cyclical part of the slowdown, which is coming out of tight monetary conditions, high real interest rates in the economy. So while the global uncertainties may continue to remain for some more time, from a local policy-making perspective, we think much of the headwinds we had prior to 2018 is slowly going away into more positive territory. So I would be a little more optimistic in terms of economic growth trends in the next 4 quarters than what we have witnessed in the last 4 quarters. Current slowdown has primarily impacted at the margin consumption-related sectors. They are both in consumer staples as well as consumer discretionary. On the consumer discretionary space, sectors like automobiles, consumer durables, housing, etc. got impacted and continue to kind of go through sluggish growth phase. Consumer staples, which have also seen reasonable volume slowdown in the recent times, we think that some of these slow growth sectors will slowly come out of the current sluggish phase once the cyclical effects of the slowdown kind of wane. The monetary policies, the falling interest rates, the tax cuts should help in boosting back the consumer sentiment, and post that we would expect the investment related sectors, which include sectors like cement, real estate, capital goods to follow the line of consumer recovery. At the beginning of the current calendar year, market had significant optimistic expectations on earnings growth for fiscal 20. This was on the back of a continued growth in the consumption sectors, normalization of financial sector, and slowly the investment sector catching up on the back of government spending. However, post last couple of quarters, we have seen significant moderation in the expectations of growth. So earlier we had 20% kind of earnings growth expectation for fiscal 20, but subsequent to the significant slowdown we have seen in the automobile and consumer durables and consumer staple sector, some of these earnings growth has moderated. Also, the financial sector, which was expected to contribute significantly to the earnings growth in fiscal 20, is also yet to come out of the earnings challenges, especially in the wake of the troubles in the NBFC sector. So all of it has moderated the earnings growth to more normal 10 to 12% kind of earnings growth for fiscal 20, which in itself should not be bad considering the fact that we have had single-digit earnings growth in the last 3-4 years. So moving into a double-digit earnings growth is still okay. The next 2 quarters is very important in that sense, that how well we recover from the current sluggish phase. So to that extent, the festive demand and subsequent to the festive demand, the winter crop and government spending during that time is very important. So we'll be looking out for trends in that space, but it's safe to say that earnings expectations have moderated to low double digit versus very high double digits earlier. We have seen various parts of the market go through corrections, not only in the large caps. We have seen meaningful correction in the valuations and the values of the mid and small caps. But it's one thing for the stock market values to correct, it's another thing for the inherent businesses to go through challenges. In many cases, we have seen it's only the stock prices which have gone through significant corrections. The businesses are not going through that kind of a volatility that we are seeing in the stock market. That gives a good indication that today, while the market is a lot more pessimistic, the reality may not be that pessimistic, and that gives a good buying opportunity. More importantly, it is very important to remain invested during downtrend, not only remain invested, but to incrementally invest in these companies which market is, because of various reasons, a lot of it to do with pessimistic sentiments, the market prices are corrected. It's very important to use these opportunities to buy these shares at lower prices. So my appeal to the investors would be to stay invested as well as incrementally continue to remain in their course of investments, continue the SIPs, make sure you take advantage of the low prices in various cap segments, whether it is large cap, mid cap and small cap. Specific to mid and small cap, we have seen serious valuation correction over the last 1.5 years. There was a time when mid and small caps were at significant premium to large caps. Today, both mid and small caps have gone at a discount to large caps. Also, if you look at the rolling 3-year basis, mid and small caps have meaningfully underperformed the large caps over the last 3 years. That gives a reasonably good entry point in terms of valuation, in terms of relative performance for long-term investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.